Welcome to EduStar tutorial. My name is Reema. Today we will study the classification of accounts, which is a basic accounting concept. You can study this in grade 11 or also earlier. Every day, innumerable transactions take place in a business. For example, in a grocery store, sale of grocery is the main transaction that generates income for the business. That is, there is an inflow of money into the business. As we all know that in a shop, for example, in a grocery store, when groceries are sold, there is a generation of money or cash. That is, groceries will generate an inflow of money into the business. Such transactions, there are innumerable number of such transactions that take place on an everyday basis in a business. Now, there is an inflow of cash, but also there is an outflow of cash. How is there an outflow of cash? Because the owner will also have to incur certain expenses. Expenses like rent for his premises, electricity, wages, furniture, fixtures, etc. So, while he is running the business, he will need to incur certain expenses to run the business, which are regular and which are one time expenses, such as the premises, the furniture fixtures, etc. may be a one time expense for the business, but there will be also certain regular expenses that the business will have to incur, such as rent, electricity, wages, salaries, etc., in order for the business to run smoothly. There are expenses of the business. So the owner may also have to incur expenses to run his business. For example, he may have to pay rent for his premises, electricity, wages, transportation charges, furniture and fixtures, etc. These are the expenses of the business. In this transaction, the business has to pay for the services and goods, and in this case, the cash flows out of the business. So, in this grocery store, which we have taken as an example, there is an inflow of cash in the form of groceries sold, but also there is an outflow of cash because there is a certain amount of money that the business will have to incur. He will also have to source his groceries from a wholesaler. In this case, his business is a customer of another business. His retail business becomes the customer of a wholesale business. So when he sources these groceries from a wholesaler, he is incurring certain expense, and these groceries are he is going to be selling at a profit to the retailer. Okay, but in both the cases there is an inflow and outflow of cash which happens on a regular basis in a business. In a business, there is inflow of money and outflow of money. Inflow constitutes the income and the outflow constitutes the expense. So now we are clear that in a business, there is routine expenses and income. The inflow of money in the form of cash will constitute the income. The outflow will constitute the expenses. So running a business entails income as well as expenses. Now, it is very important for the business to know the amount of the inflow and outflow of money, because the business needs to understand whether it is in profit or not. It will make no sense to run a business which is incurring loss. So, these transactions, whether there is an inflow of money into the business or an outflow of money from the business. These transactions need to be recorded, they need to be entered into a certain book. Okay, so it is important for the business to know the amount of inflow and outflow of money. This will help the business understand its profitability. Business income less business expenses equal profit. Inflow of money less outflow of money is equal to profit. So this is the concept that we have studied in school, that is cost price. The cost price, as we just discussed, is the expense that is incurred by the business owner in running the business and sourcing his raw material or his goods that he wishes to sell. Okay, so that will constitute the cost price of the business, and then he will add a certain profit to this and sell it to the end customer. So here business income, that is cost price, less business expenses, that is selling price, will be equal to profit. So if cost price plus profit is equal to selling price minus cost price is equal to profit. So business income less business expenses is equal to profit. Inflow of money less outflow of money is equal to profit. Inflow of money will be the selling price. Outflow of money is the cost price, will be equal to profit. Okay, so it is the same thing what we had studied in school, just that here we study it as inflow of money, outflow of money is equal to profit. Business income less business expenses is equal to profit. So we have the cash inflow and the cash outflow. It is very important to maintain a systematic record of the inflow of money and the outflow of money, because the inflow less outflow is equal to profit. The income less the expenses is equal to profit. Now, let us have a look at a very small setup that is run by a small businessman known as Mr. Desai. So, he has made a list of the transactions that have taken place in his business. So, the first item that he sold during the day is jeans, then he sold trousers. He also incurred certain expenses such as tea for staff, lunch for staff, rent, rates, and electricity. Again, there is some inflow of money. He sold a skirt 2500, ladies top 1800, ripped ladies jeans 1460. The total of his income in the day is 10,160, whereas the expenses are 2,600. So here his summary for the day shows that he has made an income of 10,160. His expenses incurred in running this business was 2,600. The difference, the profit, is 7,560. Now, by recording his transactions, expenses, and income, Mr. Desai knows his profits for the day. Okay, so it is very important that he makes a note of his profits for the day. The inflow and outflow transactions of the business need to be recorded systematically and date-wise. The inflow as well as the outflow of money need to be recorded to know if the business is making a profit. The first book in which these entries are recorded is called the journal, and the entries are known as journal entries. The prime entries or first entries are made in a book called the journal. So, Mr. Desai's manner of jotting down or noting the business transactions are suitable for a very small business setup. However, when the business is larger, they need to follow certain accounting rules or manner of maintaining business records while they are taking the note of the transactions that have happened in the business. For this, the accounting rules prescribe that the first book in which the accounting transactions are to be made is a book called a journal. So you need to have a journal And in this journal, you will make note of the transactions systematically and date-wise. The accountant will make note of the transactions systematically and date-wise. It is called a journal. Okay, and this journal has a certain format that is been prescribed by the accounting rules which all the businesses need to follow. It is also known as the book of first entry or prime entry. Okay, so we need to make the note of the transactions in a book called the journal when the business is slightly larger. The method of recording transactions by Mr. Desai is a very informal, small business. Okay, but while the business is growing and it becomes larger, they need to follow the rules that are set down by certain bodies in order to keep accounts. Okay, in order for them to maintain accounts, certain rules are prescribed. Okay, now the transactions that have been noted down in the journal also need to be categorized. Okay, so we know what transactions take place in a business, but when we make note of these transactions in the journal, they need to be categorized or classified into certain type of accounts. So Mr. Desai's method of recording transactions is suitable for small businesses. However, in larger businesses, the transactions need to be recorded and classified as per the accounting rules into three distinct accounts. Okay, so if the business is larger, the entries are made in a book called a journal. But while the entries or the transactions are recorded in a book called the journal, it needs to be classified into certain different categories. Now, the three categories are personal account, real account, and the nominal account. Okay. Now, if Mr. Desai is taking a loan from a friend, this friend is a person, okay, from whom he has taken a loan, and this transaction, loan from friend, this transaction will need to be made in the journal, okay, and it will be classified as a personal account because it has been taken from a person. So if Mr. Desai takes a loan from a friend, this transaction will be classified as a personal account as the loan is taken from a person. Thus, transactions with a person are classified as personal accounts. Okay, so loan from Mr. X. The transaction needs to be recorded. Okay, there is an inflow of money. The money needs to be returned as its a loan. This needs to be taken down. It needs to be recorded in a book called a journal, but it needs to be categorized as a personal account because it has been taken from a person. Okay, when you're taking this loan from a bank, for example, again this loan will be classified as a personal account because bank also comes under the description of person as it is an artificial legal person. Okay, bank is like say Bank of Baroda will become an artificial legal person. It is not a real person, it is a person, but it is an artificial legal person. And Mr. Desai will need to categorize this as a personal account because it is a transaction with a artificial legal person. Other accounts that fall under the definition of artificial legal person are clubs, societies, body of persons, okay, association of persons, etc. The next category comes is the real account. Okay, now what is real account? Suppose a shopkeeper is buying a computer for his business. So, in this transaction, what has happened is that there is something real that has come into his business. A. B. This thing will help him to make more money because all his systems have been um, becoming, they all the systems, it will help his systems to become faster, and this will help him earn more money. Therefore this falls under the definition of an asset. So an asset has come into the business. It is a real asset, you can touch it, you can feel it, and this will be categorized as a real account. This transaction will be categorized as a real account. So far we have done a personal account, a dealing with a person. Okay, for example, loan given to a friend or loan taken from a friend. Both the cases, you have given a loan to a person or you have taken a loan from a person. You have given a loan to a bank or you have taken a loan from a bank. In both the cases, it comes under the definition of a personal account as the transaction is done with a person. Now, in case of a real account, you have bought machinery, an asset has come into the business. You can touch and you can feel this asset. It will help you grow your business. It comes under the definition of an asset, and this transaction falls under the category of a real account. Okay, under this also we have two types. One is the tangible real account, and the second is the intangible real account. Tangible real accounts, as we just did, include furniture and fixtures, land and building, machinery. Okay, so real accounts are classified into two categories: tangible real accounts and intangible real accounts. Tangible real accounts are assets which can be felt or seen, example, furniture and fixtures, land and building, machinery, etc. Now you also have something known as intangible real accounts. So, for example, when one business will not only buy furniture, fixtures, land and building, plant and machinery, etc., which are all tangible, it can also purchase another business. The best example of this is a franchisee. So when I take up a name of another business, automatically it gives me a huge market. People will just come and purchase things from me, whether goods or services, because of the name. And this name is known as goodwill. This goodwill you cannot feel. It is not tangible, but it is definitely giving you the benefits of its name in the market. And this is known as goodwill. The other form of intangible real accounts are patents, copyrights, goodwills, and trademarks. So, intangible real accounts are those that can be monetized but they cannot be seen or felt. Example, patents, copyrights, goodwill, and trademarks. Okay, so we came across two categories, which is the personal account, dealing with the person, real account, real real assets, whether coming into the business or going out of the business, will be recorded as will be categorized as real accounts. Even for example, sale of furniture. I am a furniture store. The furniture has gone out of the business. It doesn't matter whether it comes into the business or goes out of the business. The transaction will be categorized as a real account. Nominal account. Nominal accounts include income and expenses, profits and gains. So for example, the other transactions that are taking place in a business is wages given to workers. Okay, this is also a transaction that has happened to the business. Rent paid, electricity charges, other expenses. Okay, in all these expenses that are incurred in running the business will fall under the definition of a nominal account. Basically, it deals with income and expenses, profits and gains. Okay, so if I say profit from sale of old furniture, this profit will come under the category of a nominal account. Okay, now let us have a look at the broad categories of personal account, real account, and nominal account. So personal account, under personal account we have real or natural person's account. For example, loan taken or given to Mr. Patel, loan taken or given to Mr. Desai. Artificial person's account. For example, you have done some transaction with a partnership firm like Mrs. Patel and Chabra CA firm. You have bought bonds of Bajaj Auto Limited. You have given the monthly maintenance to your cooperative society or subscription to some association, etc. Legal representative accounts like creditors and debtors. Creditors are those people from whom we have taken a loan, so they represent a person. Creditor represents a person. Debtors are those people from to whom we have given loan. Okay, again the debtor is representing a person. So it falls under the definition of personal account. Let us go through it again. In the personal account, you have real or natural person's account. For example, Mr. Patel, Mr. Desai. Artificial person's account, Mrs. Patel and Chhabra, CA firm. Bajaj Auto Limited, cooperative society, associations, etc. Legal representative accounts, creditors and debtors. Now, real account. Real account, we have tangible account, either coming into the business or going out of the business. Land, building, furniture, premises, machinery. This is your real account. Intangible account, which also falls under the definition of a real account. Patents, whether sold or bought. Goodwill, whether sold or bought. Copyrights, trademark. Nominal account has got to do with income and gains, interest received, rent received, commission received, dividend received, and sundry income. Okay, so the transactions that are recorded systematically in a book called a journal, which will have a certain format, which we will come to in the next chapter. Okay, in the next session, that has a certain format. You need to classify it into three distinct accounts, which is personal account, real account, and a nominal account. Personal account is got to do with transactions with a real or natural person, with an artificial person, or with a legal representatives. Real account, transactions related to tangible accounts or intangible accounts. Nominal accounts, transactions related to income and gains, interest received, rent received, commission received, dividend received, sundry income, also all these expenses. Now, let us classify the following into real, personal, or nominal accounts. So, machinery account is a real account. Okay. Trade expenses is an expense, comes under nominal account. Mr. Sharma's account, dealing with a person, personal account. Plant and machinery asset either has come in or has gone out. It is a real account. Freight expense, nominal account. Capital account. Capital account is a owner's money that he has put into a business. So when he is having his capital in the business, he has given a loan to the business, and this loan is given to a person. The business is an artificial person. Therefore, capital account will be a personal account. Building account, real account. Wages is an expense, it is a nominal account. Drawings account, personal account. Furniture account, real account. Electricity charges account, nominal account. Bank of Baroda account will be a personal account because Bank of Baroda is an artificial legal person. JJ Hospital account, personal account, artificial legal person. Dadar Mahila Mandal, artificial person, personal account. Import duty account is a expense, so it is a nominal account. Rent account, nominal account, and motor vehicle account is a real account. Okay, so from here we come to the end of this session, which is related to classification of accounts. The number for personal tuitions is given. You can contact me through WhatsApp. Regular online sessions are held at very nominal rates. Thank you.